The dollar is going up, and oil, copper, and Bitcoin are all going down. Margins are called, traders are going crazy, and gold just fell the most it has since 1983. Is this just a quick fix, or is it the start of a big change in the market that could hurt your investments? Tonight, the markets around the world are in chaos. Prices of all kinds of goods are going down, stocks are shaky, and risk assets are under pressure. Even Bitcoin, gold, silver, oil, and copper don't seem safe. A lot of people were shocked when the market dropped a lot, and the effects are being felt in Asia, Europe, and the US. There are a lot of different factors at play in this sell-off, including the economy and how people feel about the market. Analysts say that a perfect storm of changes in world politics, expectations for government policy, and the sudden rise of the US dollar are all putting pressure on assets that are usually thought of as safe havens or growth commodities. We're going to talk about what happened, why it happened, and what it means for investors using the most important numbers and trends. The news from Washington got the markets going today. When President Donald Trump picked Kevin Warsh to be the next chairman of the Federal Reserve, investors were worried right away. Warsh, who used to be the governor of the Federal Reserve, is known for being hawkish, which means he usually supports higher interest rates to keep inflation in check. People say hawkish Fed when they mean that it will be harder to get money, borrowing costs will go up, and risky assets will be less welcome. Traders quickly got rid of their holdings in precious metals, energy commodities, and industrial metals. People thought the nomination was more than just a new leader. It was also a clear sign that the Fed might keep rates high for a longer time, which would hurt things that are priced in dollars. Now we can talk about the dollar itself. The US dollar is going up quickly and is now at its highest point in weeks against a number of other currencies. When the dollar gets stronger, it costs more for people from other countries to buy things that are priced in dollars, such as gold, oil, and copper. If the dollar gets stronger, people who have euros or yen will have to pay more for the same barrel of oil or ounce of gold. That will naturally lower demand, and when demand goes down, prices go down too. It's a classic case, but the current market is full of fear and uncertainty, which makes it worse. Gold and silver are not doing well when it comes to precious metals. Gold fell about 5% during the session today, which is its lowest point in more than 2 weeks. Silver is even worse, losing more than 7% of its value and giving up gains that had brought it to record highs just last week. These changes are not small and happen all the time. We're talking about price changes that are like those that have happened before. To put things in perspective, gold's daily drop is the biggest since 1983, and silver's daily drop is the biggest ever. Traders say this is a mix of panic selling, margin calls, and quickly closing out leveraged positions. People who bought stocks during the January rally are now losing money fast. Because of this, people are less willing to take risks with stocks and other risky assets. What does this mean? It's not normal for the market to move this quickly with precious metals. It shows that there is structural tension in the markets between fear, speculative leverage, and macroeconomic signals. In the past, it was very rare for silver prices to drop by 27% in one day. It makes me think of the 2008 financial crisis, when people suddenly ran out of money and sold their stocks in a panic, which drove the markets crazy. Gold's 9% drop in just one session last Friday shows how quickly emotions can change when fear, leverage, and margin hikes all happen at once. The energy markets aren't safe either. Oil prices fell by almost 5% today after reaching their highest levels in months. Brent crude fell $3.50 to $65.86 a barrel, and West Texas Intermediate WTI fell $3.42 to $61.79. What made it happen right away? Making things less tense between the US and Iran. Over the weekend, President Trump said that Iran is seriously talking to the US. People were hopeful that the chances of military action getting worse in the Middle East were getting lower after this comment. Geopolitical risk was a big reason why oil prices were so high, but that extra cost is going away almost overnight. Politics aren't the only reason oil prices are going down. The dollar is also stronger. When the dollar goes up, oil costs more for people in other countries. This makes sense because demand goes down. There are also other basic pressures that analysts are talking about. For instance, OPEC Plus just decided to keep production the same for March. This means that supply stays steady even though tensions are getting better. Also, problems with supply in places like the US and Kazakhstan are becoming less urgent, which makes the market even more bearish. According to Giovanni Staunovo, an analyst at UBS, oil prices are going down today because the dollar is strong and there is less geopolitical risk. Copper, which is often used to measure industrial demand, is also under pressure. Prices on the London Metal Exchange fell by about 3% because people were worried about how much metal was in stock and how demand from China was slowing down before the Lunar New Year. Iron ore, Tokyo rubber, and other industrial metals are all following the same pattern, because investors are worried about weak demand in the first quarter of the year. Even though these moves might look like a correction in the market, the size of the sell-off shows that investors are being more cautious because the dollar is strong and they are worried about interest rates. The way trading infrastructure works is partly to blame for the volatility today. The CME Group recently raised the margin requirements for metal futures. This means that traders have to put up more money to keep their positions. When margins rise quickly, traders who use leverage often have to sell their positions right away to meet their obligations. This sped up the drop in gold and silver prices and made oil and copper prices go up and down even more. In short, what could have been a slow change turned into a quick, cascading sell-off in many asset classes. From a distance, what we're seeing isn't just a drop in prices. It's also a sign of how people feel about the world market. Investors are worried. People are less willing to take chances. Today, commodities are in a perfect storm because the Fed is signaling that it will raise interest rates, the dollar is getting stronger, geopolitical tensions are easing, and mechanical factors like margin hikes are also at play. The trend is being followed by stock markets. The MSCI All World Index is down 0.5% today. This is part of a trend that started last week when it reached record highs. The VIX shows that volatility is coming back and getting close to levels that have historically caused stress in the market. Traders should take a break and think about their positions and what is really moving the market right now. This is because there could be more changes in commodities, stocks, and even cryptocurrencies like Bitcoin in the next few sessions. The drop in prices today is a great example of how all the markets in the world are linked. A single policy announcement, along with changes in the economy and the world, can cause waves that affect all kinds of assets, including gold, silver, oil, copper, and even digital assets. This is just the first part of the story, but it sets the stage for a more in-depth look at how these markets are likely to change in the next few days. This includes how the Fed's policies and movements of the dollar will affect them, how emerging markets will respond, and how investors will position themselves. As the dust settles on today's commodity sell-off, one thing is clear: a lot of the volatility is caused by how investors think. Fear spreads quickly in markets, especially when it is made worse by borrowing money. As prices dropped, traders who had big bets on gold, silver, oil, and copper had to quickly get out of their positions, which started a chain reaction. When oil prices go up 5% or silver prices go down 7%, traders who use leverage don't have time to wait. When margin calls happen, traders have to sell right away, which makes the downward pressure even stronger. This is why markets that usually move slowly can suddenly drop a lot and very quickly. When it comes to moving the market, fear, panic, and herd behavior are just as important as the basics. Things are getting hot, not just goods. The stock markets are both going up and down at the same time. The weakness in raw materials, especially industrial metals and energy, has spread to stock index futures all over the world. Asian and European stocks started the day off with big losses. The MSCI All World Index dropped 0.5% for the day, and stocks around the world kept falling from last week's record highs. People are putting two and two together. If commodity prices go down, it could hurt the profits of companies in the mining, energy, and industrial sectors. The mood of risk-off is spreading, and people are selling metals, oil, and stocks. This shows that the world market is getting more stressed. It's interesting to see how some prices have changed today because they are based on relief instead of panic. Oil prices went up a lot when it was announced that talks between the US and Iran were moving forward. People were less worried about a military escalation in the Middle East over the weekend when President Trump said that Iran was seriously talking to Washington. This had been driving up oil prices for the past few months. Traders are starting to look at the basics of oil again as the geopolitical risk premium goes down. Oil prices fell almost 5% today for both Brent and WTI. This is because the threat of war is lessening, which means people don't need to stockpile or buy oil for speculation. It serves as a reminder that commodity markets are very sensitive to how people view risk, not just how much supply and demand there is. OPEC Plus said recently that it would keep its oil production the same in March, which makes the mood even more bearish. Some people may have thought that cutting production would help prices go up as tensions eased, but the group's choice shows that they believe supply and demand are pretty well balanced. This means that there won't be any immediate action to help prices in this case. There are three problems with oil. The dollar is getting stronger, there are fewer geopolitical worries, and production is steady. According to Giovanni Staunnovo from UBS and other analysts, the market is responding to fundamentals that are catching up with prices that were too high before. This makes the pullback almost certain. Copper, a metal used in industry, has been under a lot of stress for a number of reasons. The price of copper on the London Metal Exchange fell by about 3% today. This is because there is a lot of it in stock and demand from China is slowing down before the Lunar New Year. China uses almost half of the world's copper, and trading volumes often go down before big holidays because of the time of year. Because the dollar is strong, the metal costs more for people who don't live in the US. Copper's price drop is because demand is weak right now and the value of the dollar is low. Investors are paying close attention to whether this weakness will last after the holidays, which could have an effect on industrial demand in the first quarter. The rising value of the US dollar is a common theme in all commodities, but it affects different sectors in different ways. Because they are priced in dollars and are often used as a hedge against weak currencies, gold and silver are very sensitive to the strength of the dollar. Prices drop sharply when the dollar goes up because people don't want these metals as much. Base metals, like copper and iron ore, are also priced in dollars, but their prices are more closely tied to demand from industry. When demand is low in important consumer markets, a stronger dollar has a bigger effect on these metals. Changes in world politics and OPEC Plus policies also affect energy commodities, along with the dollar. Traders need to pay attention to a lot of different things that are going on. Comparing how the market moves today with how it moved in the past can help you understand what it means. Last Friday, gold dropped about 9% in one day, which is the most it has dropped in one day since 1983. The price of silver dropped 27% in one day, the most ever. These things are like what happened during the 2008 financial crisis, when panic, margin calls, and quick deleveraging made prices go up and down a lot. Today's sell-off isn't as big of a deal, but the similarities show how quickly leveraged positions and mood swings can move prices, even in markets that are usually more stable. Traders are watching big macroeconomic events that could have an even bigger effect on commodities in the future. The market will be affected by central bank meetings, US jobs data, inflation numbers, and economic indicators from China. For example, any hints from the Federal Reserve about interest rates or liquidity could make the dollar even stronger. This could put more pressure on commodities priced in dollars for a longer time. Also, numbers about China's industrial activity could change the demand for copper, iron ore, and energy. This would make things even more uncertain for traders who are already worried about what happened today. The spillover effect is even having an effect on digital assets. Bitcoin, which many people think is a risky investment, has gone down along with stocks and commodities. BTC has gone down about 4–5% today, which is what the rest of the market is doing. The exact numbers are different on each exchange. When the market is very volatile, the link between Bitcoin and risky assets gets stronger. People who thought BTC would protect them from inflation or be a good way to store value are now realizing that cryptocurrencies can drop a lot, just like stocks and commodities, when the market is under a lot of stress. So, what are investors doing about it? Traders and institutional investors are changing their portfolios to lower their exposure to commodities that are affected by the dollar. They are also using safer assets to manage risk. People might buy precious metals now that prices are low, even though they aren't very valuable right now. Oil traders are closely watching changes in the political world, while investors in industrial metals are weighing seasonal changes in demand against the basic laws of supply and demand. In short, the drop in prices today is making people think twice about their risk. The hawkish Fed story, along with a strong dollar, lessening tensions around the world, and the unwinding of leveraged positions have made the market a cautious place. Investors aren't going crazy for no reason. They're just changing their positions because of the pressure from all sides. It's clear that things are still very unstable as we move on to the next part of this story. It's not just headlines that affect the markets anymore. How policy, currency, geopolitical events, and investor psychology all work together also has an effect on them. In part 3, we'll talk more about certain commodity sectors, how Bitcoin has reacted in detail, and what might happen next, whether it's a recovery or more losses. This will help traders figure out how to handle this market that isn't stable. Gold and silver prices dropped a lot. Gold dropped about 5% and silver dropped more than 7%, mostly because the dollar got stronger and people had to sell to make up for their losses. Base metals like copper and iron ore fell by about 3% because Chinese industry isn't buying as much and stocks are rising. The markets for energy, especially oil, fell by almost 5%. The dollar was getting stronger and tensions in the Middle East were easing. Wheat and soybeans, which are agricultural goods, were less volatile, but they still fell by about 1%. This shows that investors were generally not willing to take risks. You can see that even though all commodities are connected, each one reacts to different things, like currency, geopolitical risk, industrial demand, and speculative positioning, when you look at how different sectors behave. This makes a mosaic of pressure points in the world's markets. When it comes to oil, it's important to separate short-term feelings from the facts. Brent crude is now worth about $65.86 per barrel, and WTI is worth about $61.79, which is about 5% less than it was yesterday. Headlines talk about the quick drop, but the facts tell a different story. OPEC Plus is keeping production steady, but in some parts of the world, there is still a limited supply of oil. Inventories in the US and Kazakhstan are down, but demand is still recovering from seasonal changes. The recent drop in prices is mostly because the dollar is stronger and there is less geopolitical risk, not because the balance between supply and demand changed suddenly. Traders and investors need to know about this difference. Short-term price drops may seem scary, but the basics say that these dips could be short-lived. These dips could be good chances to position yourself strategically if demand stays strong in the medium term. Today's drop in copper prices is due to both cyclical and structural factors. Prices are going down right now because of things that happen in cycles. For instance, demand from China is slowing down before the Lunar New Year, and there is a lot of stock on hand. Expectations for demand in the medium term haven't changed. Copper use will keep going up because of China's infrastructure and green energy projects. Some experts say that the current levels are a sign of a long-term downturn, while others say they are just a short-term break. After the holidays, investors should pay attention to China's demand data. A strong rebound could quickly use up extra stock and keep prices stable. Knowing this difference can help you figure out if copper's current weakness is a chance to buy or a sign of bigger problems in the industrial sector. Key support and resistance levels help traders who use technical signals figure out when prices might level off or drop even more. Brent crude. The first level of support is about $64 per barrel, and the first level of resistance is about $68-69, which have been high for a few weeks. If the price goes below $64, more people might sell. If it stays above that level, the market may be getting stronger. Copper. It has support at about $8,100 per metric ton and resistance at $8,400 to $8,500. If prices go back up past resistance, it could mean that demand from businesses is getting better. The most important support level for gold is about $1,130 per ounce, and the most important resistance level is between $1,790 and $1,800. Technical traders will be very interested in these levels because the next move could change the short-term trends in metals. The US monetary policy is still very important for all commodities. Kevin Warsh's nomination as Fed chair has raised hopes for interest rates to go up and stay up, which is good for the dollar but bad for gold and silver, which are priced in dollars. The Fed's decisions have a big impact on real assets. If you are hawkish, the prices of goods usually go down, but if you are dovish, that could change. People who trade are now paying close attention to what the Federal Reserve and Warsh say. This is because any change could quickly change how much risk people are willing to take on in both stocks and commodities. A lot of new markets rely on commodities, and this sell-off is having an effect on them. When the dollar gets stronger and commodity prices go down, it puts pressure on currencies, lowers export revenues, and raises the cost of servicing debt for countries that rely on commodity exports. Brazil, Chile, and South Africa are some of the countries that depend on metals a lot. They may have trouble with their budgets and have less money to spend. Venezuela and Nigeria are two countries that sell oil but aren't making much money. On the other hand, countries that buy oil are paying less for energy. The difference makes the world a complicated place, and market swings make problems with money and trade even worse. More volatile commodities also have an effect on other financial markets. All of these things are affected: stocks, currencies, and fixed income. Traders who use commodities as a hedge or a risk indicator that moves with the market have to change their positions, which makes things even worse. Investors are more worried now that volatility indices like the VIX have gone up. The value of the dollar goes up when money moves to it, and bonds go up when expectations about Fed policy change. This connection shows that commodity shocks don't just happen in one place anymore. They affect the whole economy. The current trend could get better or worse in the future for a number of reasons. Traders are paying attention to OPEC+ meetings, upcoming US economic data, decisions made by the Federal Reserve, and Chinese industrial and consumption data. If the Fed gives a hawkish signal, the dollar could stay strong and commodities could stay weak for a longer time. New geopolitical tensions in the Middle East, problems with supply, or strong demand from China, on the other hand, could all help prices. Investors need to be ready for anything, because changes in any of these factors could cause prices of all kinds of goods to go up or down quickly. What should investors do next? Futures and options strategies can help short-term traders take advantage of price changes or find good times to buy. Long-term investors, on the other hand, might see this as a chance to buy undervalued metals, energy, or diversified commodity ETFs. It's important to know how long you want to invest, how much risk you can handle, and how the economy as a whole affects each other. In today's world, where the dollar is strong, geopolitical risk premiums have changed, and margin-driven selling is going on. Positioning requires careful planning and strict execution. In short, the market today shows that a stronger dollar, falling commodity prices, lessening geopolitical tensions, and hawkish Fed expectations are all making things harder for metals, energy, and risky assets. Investors are having a hard time figuring out what's going on because psychology and leverage make short-term moves bigger, but the fundamentals for the medium term are still unclear. As people look at economic data, signals from central banks, and demand indicators from China, the market will be very important in the next few weeks. The most important thing for viewers is to stay up to date, watch important technical and macro levels, and be ready for changes. The story of the global commodity markets isn't over yet, but those who plan ahead will be better able to handle whatever comes next. The dollar is going up, and oil, copper, gold, and Bitcoin are all moving sharply. That's a full breakdown of tonight's global commodities crash. We've seen how changes in currency and geopolitics are making markets shake like never before. If you want to stay ahead of moves like this and get real-time market information, hit the like button and subscribe now. Please leave a comment below and tell us which market or commodity move makes you the most worried. We'll talk about it more in the next video. And don't forget to click the bell icon so you can get all the news right away and make better, faster choices about your portfolio.